Okay, great. All right. So Scott Lucas here with Lucas Financial Services and Wisdom Tax Group, and thank you for attending today. But I wanted to share a unique investment that I think has a lot of potential. Michael, how do you pronounce your last name? Is it Anise?
Exactly, just like the spice. Anise.
Okay, all right. And he is the CEO of FG Communities, and we get a lot of different investment opportunities that come to my inbox, and our CEO Amy had shared this with me, and I looked at it, and it appealed to me for a number of different reasons. One, I think it's got a great sector, which is the affordable housing. A lot of demand for that, and I think a very positive sector. Secondly, I had some clients that were one of the mom and pop scenarios that did really well in this sector, and so kind of had some personal experience with how well they did in that industry. And then and I think what Mike's going to share with you is a lot of what they're doing, as well as some other huge investment firms, is they're consolidating from a lot of these mom and pop businesses, and that's really what he's going to share with you in more detail. And the other thing is that it's a structured return. Keep in mind, this is not guaranteed. There's no guarantees in investments like this, and there's certain risks involved. But it suggests that they are structured well in order to put themselves in a good position to be able to offer the distribution strategy that they have. So with that said, I'll let Michael get started and run through the presentation with you.
Great. And thank you, Scott, for that introduction. And thank you all for taking the time to learn a little bit more about our company and the industry. So as Scott mentioned, my name is Michael Anise. I'm the CEO of FG Communities. As you can see here, our mission is to preserve and improve affordable housing. So what we do is we own and operate manufactured housing communities. One of the things that I'd like to share right off the bat is or ask if any of y'all had any experience visiting any mobile homes or manufactured housing communities, or do you have an idea of what that looks like? And the reason why I asked that question is there's a lot of misconception out there of what these things look like. So I'd like to start by just sharing some of the pictures of some of the actual homes within our communities. And if you look at them, you can hardly tell you're in a mobile home, right? These are nice open floor plans, stainless steel appliances, island kitchens, and these things are range from anywhere between 800 square feet to over 2,000 square feet, depending on if it's a single wide or a double wide. But as you can see here, these are kind of like almost luxurious like from inside. Here are some of the outside pictures of actual homes within our communities, so you can get an idea of what they look like. But the reason why we do that is because although it is our mission to provide affordable housing for folks, it's also is our mission to preserve and improve this asset class. This asset class has a lot of misconception and a lot of stigma out there, but what we pride ourselves of doing is taking mobile home communities from mom and pops and putting in that deferred capital that they couldn't otherwise afford to put into their communities by improving the infrastructure, providing a better quality of life for tenants, and improving the tenant base or repositioning the tenant base by running background checks on everybody, not so much for credit, but we have rules and regulations just like any other community with our own HOA type of regulations that prohibits or make sure that everyone that lives in our community has a clean criminal background check. We want to make sure that we kick out any troublemakers that are not respecting their neighbors, that are not respecting our rules and regulations, improving the infrastructure, utilities, roads, landscaping, security cameras, and really turning it from, a trailer park to a mobile home community or a manufactured housing community. And when you do that, you get rewarded because the tenants have a better quality of life. They see the benefits of living in a professionally managed community versus a mom and pop. They see the benefits of a company coming in with a lot of resources that can afford to put in the capital to improve the lifestyle and the infrastructure of the community, and turning it into a better, much more improved quality of life. So even though we operate in the affordable housing space, but we pride ourselves in improving the quality of life for our tenants to turn it into a professionally managed manufactured housing community than what the mom and pop could or were able to do. First, I'd like to tell you a little bit about myself. I'm the CEO of the company, but I'm an accountant, CPA by trade. I grew up in the accounting world after graduating high school or college from FAU in Florida. I had the opportunity to be an executive CFO of many publicly traded companies and privately held companies. I actually had a niche of taking small companies public, doing IPOs and reverse IPO technology, which is finding a public shell and taking smaller companies and taking them public that way. And because of my opportunities working as an executive CFO for many of these publicly traded companies and privately held companies, I've had an opportunity to work in many sectors, ranging from technology, pharmaceutical, lending, and lately real estate. And in 2016, I was approached by a real estate investor that wanted to take a real estate company public. And he knew that I had this background experience in taking companies public. And his company was positioning itself to aggregate mobile home communities. And he wanted to take that company public, in which I've helped him take that company public in 2017. And I really got to learn and understand the benefits of this sector. So not only was I the CFO of the company, but then I've been promoted to be the president of the company. And I sat on the board of directors as well. And then I've also became as the acting COO for a while. And I really got to learn and understand this business inside out. And by far, this has been the best vertical or best line of business that I've ever been involved in from all of my years' experience across these other industries. And, I got to really learn it and understand it and love it so much that I had the opportunity to own my own communities as an investment. And it was by far the best investment that I've made personally. I just enjoyed the business, enjoyed the returns, and I've been involved in this sector, ever since. And when I left in 22 last year to open and create my own manufactured housing company, I couldn't find a better partner to do that with than my two partners here, Kyle Sermonera and Joe Moglia. So a little bit about my partners. Joe Moglia was the president and CEO of TD Ameritrade. I'm sure you've all heard of TD Ameritrade, and he was a Merrill Lynch executive. And after he left Merrill Lynch, he became the CEO and president of TD Ameritrade and grew that company very well. And that company now is part of Charles Schwab, as Joe Moglia through his relationship with Kyle Sermonera, was able to grow TD Ameritrade and sell and merge with Charles Schwab. And now Charles Schwab owns TD Ameritrade. So Joe has very long, extensive experience in investment banking in the financial sector, and he obviously has the experience in taking companies to the next level and growing them to a very large stage. Kyle Sermonera, who's our other founder and partner in this company, has over 25 years of financial service experience. He was the fund manager for T. Rowe Price. T. Rowe Price is a very big fund, mutual fund, and he was able to, at a very young age, be their fund manager, and he helped fund Joe Moglia's TD Ameritrade. At one point, T. Rowe Price was one of the largest shareholders of TD Ameritrade and allowed them to grow through acquisitions to the point of where they were before selling to Charles Schwab. Then Kyle Sermonera left T. Rowe Price and started working with Steve Cohen at Point72. And Steve Cohen is one of the biggest, largest hedge funds managers out there. Now Steve Cohen owns the New York Mets and among other things. But really, between Kyle, Joe, and myself, we have a group of executives that really have a vast experience and long-term experience in knowing how to grow the companies the right way, getting the best value for their shareholders. And we're looking to do the same thing here with FG Communities, which is taking this company and growing it to 5,000 home sites in the next 2 or 3 years. And, whether we take it public at the right time or converting it to a REIT or, monetizing the portfolio at one point by merging with another company, we're going to do the best strategy to get the shareholders the best value as possible. So a little bit about our industry and our sector. Why do I like this business so much? Well, first of all, this is an impact investment. We're doing something that's really impactful, and it's something that's really needed out there, which is affordable housing. I mean, let's be honest, the average folk can't afford to buy a home these days, okay? And they can't even afford rent these days. And when you look at our affordability factor, you're talking about, you can buy a mobile home anywhere between 45,000 to 73,000, depending on the square footage and how fancy you want your mobile home to be, compared to either an apartment or a stick-built home that now is averaging anywhere between 350 to 460. So we're talking 460,000 if you want to buy a home for the same square footage, same number of bedrooms as you can buy a mobile home, for 50, 60, 70 grand. And that's delivered, installed, ready to go. So the affordability factor is pretty huge. It's pretty significant. And, you're talking 2 or 3 bedrooms, anywhere between 1,000 to 2,000 square foot. You don't have a neighbor above you. You don't have a neighbor beneath you. You have your own lot. You have a designated parking spot. You have a lot of that single family home characteristics for a fraction of the cost. And that's why this is the most affordable option that you can have, that's not subsidized, by the way, than any other real estate housing option out there. And even if you want to rent a mobile home compared to rent any other option out there, we're talking renting a mobile home community or a mobile home within our communities for maybe average of about $800 a month. You compare that with at least $1,600 plus in any other housing option, whether if it's an apartment or a very small single family home for the same square footage, same number of bedrooms, you're cutting your housing costs in less than half. So it is very affordable, and we're doing something that's very impactful and needed everywhere in the country that everyone is looking for. But this is something that's extremely high in demand. We have a waiting list in all of our communities. We're 100% occupied in all of our communities. We acquire communities from mom and pops that are already fully developed, fully occupied. So there is very low adjusted risk in what we do, in that sense, that we're acquiring assets or properties that there are no development risk, it's all developed, and it's fully occupied already. We're basically going in, but implementing our professional management processes and procedures, improving the infrastructure by putting in that deferred capital that the mom and pops couldn't afford to put in, providing a better quality of life, adjusting rents up to market. And we're acquiring these communities with going in cap rates at anywhere between 8 to 9, 8 to 10% cap rates, and quickly after the first year, turning them into a double-digit cap rates, anywhere from 10 to 12% and above cap rates, and that increases every year thereafter. So they're very profitable and very low risk-adjusted types of returns. And as I said, the demand is so high that we have a waiting list in all of our communities because the demand is just so high because they're not building them anymore. They're not able to develop or build any more mobile home communities. And you ask yourself, well, golly, everyone is crying for affordable housing, and these things are so profitable. Why aren't they just building them, left and right? Well, it comes down to money at the end of the day. Unfortunately, the cities and municipalities don't issue the zoning or entitlements to build any more mobile home communities in major metros anywhere. Now, you can be in some very, very rural area, and you may get that zoning or entitlements to acquire or to acquire land to build a mobile home community. But if you're anywhere close to a major metro, they just don't give you that zoning or entitlements to do so. And they do that for two reasons. Number one is that the mobile homes are considered vehicles. They don't contribute any real property taxes to those municipalities or cities. So there is no monetary incentive for the cities to approve projects like these because they don't contribute anything in form of taxes to these communities because the homes are considered vehicles. You get the titles from the DMV, just like a car. And the second reason is that there is still that NIMBYism and stigma out there. So anytime we get close to get approval from the city and councils, from the city councils to develop a new community, all the surrounding property owners think that because this thing is being built, it's going to devalue the value of their properties, and they show up and pressure the city councils to turn it down right away. And unfortunately, they cave to that pressure because they want to get reelected, and they don't approve any of these development projects for that purpose as well. So you combine the fact that they don't build them anymore, and you combine that with the fact that a lot of developers out there are buying mobile home communities in good area and kicking everybody out so they can build something else because that land value now is higher and it's in a major metro. And that is truly an asset class that's diminishing in supply. So when you're talking something that's in very high demand, but yet diminishing in supply, the value of our properties increase every single day. And that is why our mission is to improve and preserve this affordable housing asset class. So it's not just about acquiring these communities and improving them, but we're also preserving them from the developers that are buying them, kicking everybody out to, put in a multifamily apartments or, a storage unit because you can build storage everywhere. It's so saturated. We're talking about something that's truly, it's becoming scarce, and we're trying to preserve it and improve on it. And that's why the value of our communities are increasing every day. Another reason why I really like this asset class, it's because it's very recession resilient. Okay. There are only 3 publicly traded REITs in this space. There is Sam Zell, ELS. The stock symbol is ELS, Equity Lifestyle Properties. There is Sun Communities, and there's UMH. And if you look at these 3 publicly traded companies, if you go to their SEC filings, going back to the 80s crash, the 90s downturn, the 2007 financial crash, and I've had a chance to even experience that myself during COVID. So at every economic downturn, you see their occupancy goes up and their rental rates go up. And that is because at every economic downturn, everybody's trying to control their housing cost. And everybody's trying to downsize and control their housing costs by moving into something that's more affordable. So any economic downturn, we see a huge demand for this asset class, and it becomes something that's very, very high in demand. And during COVID, when everyone was struggling with occupancy because folks were exiting things left and right, and even more so with collections, right? We had and maintained almost 100% collections and 100% occupancy with a waiting list. And that is simply because our leases are all month-to-month leases, because we're not worried about folks going anywhere for mainly 2 reasons. 90+% of our home sites are tenant-owned homes. So these are folks that own their homes and they just pay us lot rents. So we have pretty much a land lease model. We acquire the land and the community, and folks that own their homes on these communities pay us lot rent. So it's a land lease model that's very resilient, and it's also very sticky. So we're not worried about these folks going anywhere because they can't really move their home. Even though it's a mobile home, it costs a lot of money for them to move these homes, and they can't really afford it. And number 2, even if they can't afford it, where are they going to move where are they going to move these homes? Because there are very few places that are zoned for manufactured housing and mobile homes that they can't move these homes to a lot of options. So even if they can afford it, they can't move it. We have mobile home dealers, mobile home dealerships that tell us, hey, if you have any space available, please let us know, and we'll put our mobile homes on your community for free because we can move it faster. Because folks would love to go buy a mobile home because it's so affordable and it looks great. You can't, even tell you're inside a mobile home by some of those pictures, but where are they going to put it? Because there are very few places that are zoned for these things, that they love to see us have any openings in our communities. So even mobile home dealers would love to put their products in our communities to move it faster. So our tenants are very sticky. The average tenant stays in our community for over 17 years.
Wow.
So they're not going anywhere. And when they do this, if they ever do decide to move, they end up giving this home to their child, their mom, to a family member. But of course, we have to qualify them as a tenant and go through the same underwriting process as we would with any other tenants, by meeting our no criminal background check, income requirements, and all of that good stuff. And obviously sign that they have to live with our rules and regulations that we send to everybody. So again, it's a very sticky model. It's a very profitable model, and it's very recession resilient. And again, when you combine all of that with the fact that, we have an experienced management team, we manage our own assets. We don't outsource that. No one is going to manage your property better than you do yourself. And that's a philosophy and principle that we live with. And that's why we've created and developed a first-class property management team to manage our communities from A to Z. And a lot of these folks that I've helped train and I've hired from a previous company have now followed me into this company so we can grow this portfolio together. So we talked a little bit about the affordability, and the scalability of this portfolio. Here we're positioned and anchored, and our corporate offices are in North Carolina, Charlotte, North Carolina. And we're focused on growing our portfolio within the Sun Belt states. The Southeast is where our footprints are, but most of our communities are in the Carolinas. And 15% of the population in North Carolina live in a mobile home. That's kind of like the lifestyle of the South, as they like to say, and people understand the benefits and the value of living in these communities and in this type of home versus any other home. So we've created a lot of relationships with smaller operators, vendors that give us referrals, brokers that only give us deals on a pocket listing that they don't share with anybody else, because they know that we can execute and we do right by their communities. One of the first things that the mom and pops ask us in order for us to win deals is, what are you planning to do with the community? Because they've inherited this legacy inheritance from their parents and grandparents. It's been their sole source of income for a while for them and their family, and they've developed relationships with the tenants, and they want to make sure they do right by them. They don't want to sell it to anybody who's just going to kick everybody out to develop something else, or they're just going to come in and hike up rent so high that doesn't make it affordable anymore, for their tenants. So we're very sensitive to that. And given the background of our co-founders, we're not here to be, rich and gouge anybody and do something like that. We want to build a legacy company with our names behind it to preserve and improve this asset class, do right by the tenants so they can do right by us. And the first thing that we do is we give comfort to that seller that we're going to do right by their legacy community, so they feel very comfortable selling it to us. And even after we buy the community, tenants, when we buy the communities, the first thing that they're scared about when we talk to them is, are you kicking us out? Because we've heard horror stories of folks that are coming in, buying these things, kicking everybody out to build something else. They don't care how much you increase rents. They don't care what your rules and regulations are. They'll live by it, because for the most part, they're good, hardworking folks, but they just want to make sure that they still are going to have a place to live and a place to put their homes in. And once you know that we are a good professional property management owner operator of these mobile home communities, and that is our business model, is to preserve and improve these communities, there's a huge sigh of relief, and they work very well with us to maintain these homes and their communities and live within our rules and regulations. So again, when you're talking about a company that has that experience and that philosophy with the executive team at the TD Ameritrade level, at the T. Rowe Price level, at the 0.72 hedge funds level, the publicly traded companies level, that knows how to take companies the right way and grow it and give the best value for our shareholders, we're really excited about our future to grow the company the right way with the right folks and keep on increasing the portfolio. Our goal is to get to about 5,000 home sites within the next 2 to 3 years within the Southeast mainly. So think Southern Virginia all the way down to Florida and as far as west as Texas. This slide is a little bit dated. This is just an overview pictures of some of our communities. I encourage everyone to go to our website, fgcommunities.com, to look at the addresses and pictures of some of our communities. We're right now close to 900 home sites. We just bought 3 communities last week. We bought 2 communities the week before. I got 17 other communities in the pipeline that we're closing on in the first quarter. So we're growing pretty fast. And the plan is to take this company to about 4,000 or 5,000 home sites And, before we, try to convert to a REIT or go public. But the sky's the limit, after that. We're trying to get to 10,000, 20,000 home sites. Those top publicly traded REITs that I talked to you about, and even some of the non-publicly traded REITs that operate in this business, they have in the 100,000 plus home sites. So there is definitely a lot of ground to cover. And one thing that I love about this sector, this is a very fragmented sector. And what do I mean by that? What I mean by that is that the top operators, including those 3 publicly traded companies, plus the next 40 non-publicly traded operators that owns tens and tens of thousands of these assets, they only control 15 to 20% of the market. So 80% of these mobile home communities are still owned by mom and pops and smaller operators. That's why we can have a long runway of aggregating these small communities from mom and pops at great cap rates, great returns, and professionally managing them and giving those returns to our investors and our shareholders. So very fragmented market, very recession resilient. We love the Southeast for a couple of reasons. We see a lot of people migrating from California, from the Northeast, because of the moderate climate that we have here in the Southeast. And, let's be honest, I wouldn't want to buy or invest in California or New York and some of those states where there are, landlord, non-friendly landlord laws with rent controls and, things like that. So we love the Southeast because it's not as, liberal in their laws, and they have a lot of still landlord friendly laws that give us that flexibility to operate and aggregate assets within the Southeast. And we see a lot of migration. That's where the growth is in the country. You see a lot of folks migrating out of the Midwest, Northeast, and out West and coming into the Southeast. So we think because of that growth in population, there's going to be continued ongoing increase in demand for affordable housing. And we want to take advantage of our position being anchored and incorporated here in the Southeast and the Carolinas to grow that portfolio. And again, just some of the pictures, just a sample of some of the pictures that we have in our communities. So, we've covered a lot of things, and I want to, leave some time for some Q&A. If you guys have any questions that I can answer, but I would like to go over the actual preferred offering that we have and some of the terms of that offering. And Scott can elaborate on that a little bit too more after I give you a brief summary. So unlike other sponsors out there, this is not a fund, okay? We don't take acquisition fees, disposal fees, management fees. There is none of those fees because this is not like a fund that we're putting together and we're just making money off of that. We are common shareholders, and our only incentive is to grow this company. And we have true equity, skin in the game. All of the communities that we've acquired so far has been coming out of our own pocket that we leverage with senior debt. So we go out there and we get bank debt for about 60 to 70% of the purchase price. And we put in our other, 30, 35% money in a form of common subordinate to you all as preferred investors in these communities. And we're going to maintain that ratio of about 15% common equity that we put in out of our own pocket, subordinate as an additional level of protection to you as a preferred shareholder. But the preferred shareholder gets to come in at this offering. It's $100 million offering, in which we're basically paying 11% annually to the preferred shareholder. 8% gets paid current in monthly distribution So you're getting 8% current and monthly distribution, and 3% every year is being accrued until redemption in 5 years. So after 5 years, we fully have to redeem your preferred shares, give you your full principal back, and the 3% a year that you've been accruing. So 15% plus 8% every year. So again, it comes up to 11%. But currently, with this offering, we're doing two things to make it even a little bit more attractive than 11% per year. We're offering 6% of your investments. We're giving you $3 warrants or options to buy our common stock at a $3 per share price. And what that does, it gives you the opportunity to also participate on the upside. So instead of just getting 11% per year, which is pretty decent, you're also getting the opportunity to participate on the upside. So when and if we go public or IPO or have a liquidation event or even convert to a REIT and start, paying consistent dividends, you'll be able to be a common shareholder as well at a $3 per share and participate on our upside. So if you invest 100 grand, 6% of that or $6,000, you'll get for free worth of $3 warrants or options into our common share. And also the first 10 million that comes in the door, which I think we're pretty close to closing that out, you're going to have a 10% discount. What does that mean? That means that if you contribute 100,000 into the funds, you're actually going to get paid on 110,000, and you get back 110,000 at the end of the 5 years. So your 11% becomes a little bit more than 11%, because even though you contribute 100,000, you're getting paid on 110,000. That's on the first 10 million. The second 10 million is a 7.5% discount, and the third 10 million is 5% discount. All of these were expiring at 12/31, but I think we're just amending that to extend it through January, so folks can have the opportunity to come in, because we only really started that program in November, and we want to be fair to folks to give them some opportunities for more time to get into the fund or to this offering with the discounts that we're offering. So again, it's 5-year redemptions at 11% per year, 8 current, 3 being accrued every year for the 5 years. You get the 6% of your investments. You get $3 warrants, and at any time, you have the option to convert or to take your entire investment and convert it to a common share, or we give you warrants of $17 per share in a form of common as well. And that's just another added feature. So if and when we go public and you see that there's a lot of upside there, then you can take your 11% per year until you convert or exercise the warrants at also $17 per share for your entire 100% of your investment to participate fully on the upside with that. So there are a few ways there that you can participate on the upside or just enjoy those 11% plus returns for 5 years until we redeem your preferred shares. And again, our website right here, fgcommunities.com. You can email us directly with any additional questions at info@fg.communities.com, or also IR for investment relations, IR@fgcommunities.com. And obviously Scott is there for y'all to answer any questions. I know I've said a lot of things and I've covered a lot of ground, but I want to now open it for any questions and answers, for you folks, for y'all to help participate in the conversation. Thank you.
Yeah, Michael, I had one. So you were talking about maybe extending the discount into January. Do you have any idea when there will be more of a firm, determination on how that will be structured?
Yeah, so I think we're not gonna change the different categories of the discounts. So because we're so close to almost finishing the 10 million. There may be a little bit room for the first 10 million and the first 10%. Whenever that first 10 million is raised, the 10% expires no matter when in January it goes into. But we're just extending the 7.5 and the 5% until they're basically are raised for the first 30 million.
Okay, got you.